Welcome everybody. Will Gomez here once again for the Perpetual Pip, and it's time for our next discussion on our Trading 101 series. What we're going to be talking about today is slowly but surely we're upping our difficulty level, right? Or perceived difficulty. Usually that difficulty revolves around us not necessarily knowing the topic before. So we're taking everything that we've learned so far and we're applying it step by step to being able to develop our understanding of the market. Today, we're going to talk about how to deal or how to cope with a market reversal. So let's get started talking about that. So far, we've explored how to interpret trend direction, right? We've talked about the different methodologies on how to understand how the market develops these waves. Who is winning what round, be it the bulls or the bears. But the fact of the matter is that neither of these contenders can carry on indefinitely, right? They can't continue winning all the time. At some point, the trend is going to change and the feared reversal ends up taking place. And so this is usually where traders can lose a significant amount of equity. It's when they're not ready or they're unwilling to accept the fact that the market cannot simply trend in one direction indefinitely. The bulls or the bears will take over and they're going to turn that trend around. So we've got to be equally prepared to deal with opportunity in either direction. Now, it doesn't mean, that you absolutely have to trade every single opportunity. I've known traders that will only take buy opportunities, traders that will only take sell opportunities, and they're doing fine. It's okay for you to develop a specialty that you prefer to trade. However, you definitely, at the very least, want to be able to recognize these changes when they're occurring so that if you've made that choice to only trade in one direction, you know when it's time to stop. So let's go about talking about these different types of reversal patterns. Sometimes they've been referred to as crown patterns. Other traders will call it head and shoulders. But in any case, I don't want you to feel nervous about this. If you've been with me so far watching these other videos, then you've already explored the Fibonacci phenomenon, the Fibonacci sequence that seems to govern these markets as well as almost everything else in nature, right? So this isn't anything that you don't know already. This is simply one A, B, C, D in one direction, followed by an A, B, C, D in another direction. Once we learn how to identify this, we can learn to take advantage of opportunities in multiple directions. So here's how this is going to work. Let's do a quick recap about what we talked about before. We discussed that there are only two reasons why the A-B boundary should change. The first one is when the market fulfills an A, B, C, D target, in which case the trend continues, right? C is going to become a new A, the D is going to become a new B. And we kind of explained that, right? The initial rally from A to B, the market retraces from B to C, and then eventually extends from C to D. Once this A, B, C, D sequence fulfills itself, C should become a new A, right? And the D should become a new B. And from then on, we can once again track the pattern yet again. The market should retrace to give us a new C. The other way that the market may change the A-B boundary is when the C takes out the A, right? We talked about this in the Fibonacci lesson. Now, just like the Fibonacci lesson, please look into the description or the comments section for the notes. I will put the Fibonacci notes, I will include it in the description here for this video, as well as the notes for this, for the crown or reversal pattern. Okay, worst case scenario, if you're watching this on YouTube, you should definitely be able to use the links in the description portion. If not, you can always email me directly, will@perpetualpip.com or perpetualpip@gmail.com. I'll be more than happy to get you in contact or get those notes out to you. Okay, so that second way that the A, B, C, Ds can change is when the C takes out the A, in which case we have to accept that the trend is no longer valid and is getting ready to turn around. So it simply boils down to, okay, if I have been tracking A, B, C, D Fibonacci's in one direction, in the bullish direction, the market has taken out my A. I can't say that it's going to be able to continue to do that, so I have to accept the fact that it's reversing. I'm just gonna start plotting in the bearish direction. So this is pretty much how that works. You've got an A-B boundary. The market retraces to give me a C. It should go to the D extension, but instead what it does is it ends up going past my A. And taking out the A, I just want to put that out there right now, also includes touching the A price. As we discussed in the ABCD or Fibonacci lesson, we talked about how if the market touches the A price, that's considered a 100% retracement. So if it does touch the A, that's considered taking out the A. If it exceeds it, then obviously that also includes that as well. And that's the point in time where we would simply start to reverse draw our Fibonacci's in the opposite direction. So now that we understand this basic methodology, again, I just want to reassure everyone here, although this appears to be complicated, rest assured that if you simply reference the rules, the more comfortable you get with these Fibonacci retracement and extension rules, the easier it's going to be for your mind to adapt to this pattern methodology and be able to spot how to draw this appropriately, right? The head and shoulders and the crown are simply ABCD patterns. And since it's an ABCD, an Elliott wave, they have to obey the exact same rules that we talked about in the Fibonacci lesson. So this is pretty much how that's going to play out. If you've been tracking an ABCD pattern and all of a sudden your next AB boundary fails, you'll be able to execute that reversal. Okay, so here's my ABCD completed. I then know that C should become A and D should become B. What the market should do next is retrace to give me another C and then to the D, but instead what it does is it goes past the new A price. By exceeding or taking out the A, even by touching the exact same price point, that AB boundary would be considered to be failed. And so I would have to recognize the fact that the market is reversing. I need to once again follow the rules for plotting ABCDs just in the opposite direction. So in this case, I'm going from an uptrend to a downtrend. My highest high is going to be my new point of origin for my reversal, and my first low is going to be the first B point. The market should then retrace to give me a C, and I can look to participate at C going to the D extension target, just like any other Fibonacci. The only difference is when learning to identify the crown pattern, I can not only identify that this is happening while it's happening, but I also have the opportunity to participate as it occurs. Okay? This is the document that I was talking about before. This contains the 5 steps to the reversal pattern. All right, 5 steps to the reversal pattern are included here in this. You will be able to access this below this video. If you're watching this on YouTube, you can go right down into the description section and you should see this, a shareable link for this document, as well as the ABCD Fibonacci rules. All right, so again, you can download this, you can print it out and have it for reference later on in case you need some study materials. And so please feel free to go ahead and reference that. But let's take a look at how this actually plays out. First, conceptually, and then we'll see it in action on an actual chart. Here are the 5 steps, right? And I'm going to have these down here so that you can reference this as the movement evolves. Let's say we've been tracking an uptrend, and I use uptrends a lot when I go to teach this because uptrends tend to be easy to absorb, right? It's easier for traders to kind of work in a right side up environment versus an upside down environment. But again, we get into the different, the rules remain the exact same. I cover more thorough information on this in my actual live lessons. For the purposes of this video though, here is the trend that I've been tracking so far. The market has been evolving in a bullish direction, creating these A, B, C, D waves. C becomes A, D becomes B, and so on, until I get to the current A, B value, right? So with this current A, B boundary, what the market should do next is it should pull back just like it has been, either bouncing off the trend line or bouncing one of the Fibonacci levels. It should pull back to give me some sort of C, and then once it bounces and gives, after giving me that C, I can look for yet another opportunity. Who knows, maybe I've been successful so far getting in at this C, taking profit at the D. I got in at this C and I took profit at this D, and so I'm getting ready for the same thing, except that what the market actually does is step number 1. Step number 1 is when the market takes out or breaks a trend line. Okay, when the market takes out or breaks a trend line, that is the first symbol that it's getting ready to change direction. However, I'm not going to panic. And as a trader, you don't have the luxury to panic anymore. You cannot allow yourself to become subject to emotions taking control, right? You cannot allow your emotions to take the driver's seat. Instead, you have to try to rein it in. We're not going to panic whenever a trend line breaks, or indeed, we're going to work to never panicking, because whenever the market breaks a trend line, it doesn't necessarily reverse the trend right then and there. If you've got your Fibonacci in place, as we discussed before, there are multiple levels that could realistically cause this market to bounce. And if this market did bounce and come right back above the trend line, you were looking at a false break. If you took a look at our trend line discussion, then you know that the trend line is always drawn between the lowest low and the highest high. And if this market should come to give us an even higher price, then this trend line would no longer be accurate, because we would have to adjust it to accommodate for all of the lows before a new higher high. So you would be dealing with what's known as a bear trap, a fake out, right? Don't fall for that. The only time that we spring into action is when step number 2 occurs. When the market takes out, and that means, once again, if it touches the A price or exceeds the A, that's considered taking out the A. So once that takes place, just like you would with a normal AB boundary, we accept that the trend that we've been tracking has come to its end. And if that's the case, we start to make moves. We can take it a step further and start to prepare to participate in the reversal as it unfolds. The way that we're going to do that is by moving on to step number 3. Step number 3 calls for us to identify the left tip. Now, in no uncertain terms, I just want to put this out there right now, that the left tip must always be, it needs to be the B of the previous completed AB boundary. Right? It's not going to be this point right here for 2 reasons. Number 1, the center tip needs to be the most prominent point of the entire reversal. And number 2, it's got to be a completed AB boundary B point. Since this AB boundary failed, I certainly cannot use this as my left tip point. Remember that, because this is usually right around where things start to get pretty muddy and traders can stumble. So your left tip needs to be the B of the previous completed AB boundary. If I take a look at this, the only reason why this is my AB, or this was my AB boundary, is because the previous ABCD fulfilled itself, which means this is going to be my left tip. I will take that price point and I'm going to put a line going across that price point over here. And the reason for that is as a reference point. That price is going to be a reference point. Why? Because if this crown is going to be symmetrical, and many of them are, then what I'm looking for is for the market to most likely give me my opportunity to participate in the reversal somewhere around that same price point, this time though at the backside of what was my uptrend line. As we know, as long as the market remains to the left side of any trend line, it's continued to bounce. That trend line has served as support. Now that the market has fallen through, just like skating on an ice lake, right? If you've been skating on a lake that has frozen over, it's fun, but that same ice that's holding you up could potentially hold you down if you were unfortunate enough to fall through. So right here, this market has fallen through, and now the backside of that trend line could realistically act as resistance, forcing the market down. With step number 3, I identify a price that the market will more than likely bounce at. Now, step number 4 comes. Again, it's not anything that you don't already know. You're going to look to draw your new AB boundary to project the right tip of your new crown. That's going to be your entry opportunity. So following the rules, I'm going to draw from the highest high to my first low for my new AB boundary. And I'm going to be looking for the opportunity to form, as I discussed, somewhere around this price point at the backside of the trend line. When that opportunity presents itself, then relative to the new AB boundary, I've got myself my C. And I look to participate at C's, provided it gives me the appropriate candlestick formation. We're going to talk about that entry opportunities in later lessons. For now, I want everybody to understand what's going on in the markets. So at that C, I will go ahead and participate. That would be step number 4. Once the market goes ahead and fulfills that A, B, C, D, I'll have my new trend on the way. We can move on to step number 5. I try to not really bang on too much about step number 5 because step number 5 is the easiest here. You're simply just going to be drawing a new trend line to accommodate for the new AB boundary. So you connect your new A to your new C. That's going to give you your new trend line. But this is that crown pattern, right? That reversal pattern, the head and shoulders. The main difference between the crown and the head and shoulders is the head and shoulders, in my opinion, is a little bit more dangerous. Instead of waiting for this confirmation here, the bounce at this price point, the head and shoulders calls for you to enter in immediately at the break of the neckline. This being your left shoulder, this being your right shoulder, you get in immediately when the market breaks the trend line. And I personally don't subscribe to that too much because there's the possibility, again, just because the market has broken a trend line doesn't mean that it cannot come back above it, right? So for me, this kind of bounce away from the line is way more reassuring, and I personally prefer the crown pattern than the head and shoulders. That's just a personal choice. It gives me that much more reassurance the market's going in my direction. Last but not least, here is our left tip, center tip, right tip display. Let's take a look at this on an actual chart. This is the Euro Canadian dollar on a daily scale. You'll be able to find these reversal patterns on all currency pairs and all time frames. But I want you to see what it looks like on an actual chart. So here we have the trend lines that would have been in place for this trend when this was on vogue, right? This is back in February of this year. If I'm not, actually, this is 2014. I went a couple years back just so that I can show you a nice little example. All right, so here is the market, and we have these A, B, C, Ds developing here, right? Everybody see that? A, B, C retracement, D extension, target fulfilled. Then that became a new A, this became a new B. The market came to the trend line, bounced off the trend line, and fulfilled the next D target. So C became A yet again, D became B. There's my current AB boundary. What I was expecting at this point in time was that the market would come back to the trend line, bounce off of it, maybe go to the outer trend line. But instead what it did was it broke the trend line. That's step number 1. The market then took it a step further by coming to where my A price was and exceeding it, going to a lower low. It's at this point I have to accept the market's reversing, right? If this had been live, I would not have been aware of any of this, but I could have certainly started my preparations. So at this point in time, I identified my old A, B, C, D, previous completed AB boundary. That's going to be step number 3, my left tip. And I'm going to note that, or I'm going to start to expect that most of the time the market's going to create an opportunity somewhere around that same price point. The next step is to draw my new AB boundary. And of course, I'm following the rules. So for the reversal, if I'm going from bullish to a bearish trend, I'm going to start at the highest high, and I'm going to make sure I go only to the first low, following the rules. Once I have that new AB boundary, I'm going to see that the market will likely retrace to the backside of the trend line. It did give a bearish candlestick formation right here at the backside of the trend line. It gave a bearish candlestick formation here at the backside of the trend line. So any one of these points could have been a point that I got involved, right? The crown will not always be perfectly symmetrical. What is important is that it follows those rules that we talked about. So in any case, if I participated and I sold this market at one of these bearish candlestick formations at the backside of the trend line, we can see that the market eventually fulfilled its D target. You've got an A, B, C, D in the opposite direction. Step number 5 would have been this, for me to draw my new down trend line. And as you can see, the market is now subscribing or obeying this new down trend line and trending along it. This is the crown pattern. This is going to bring us to the conclusion of our crown discussion. I know that this can be a little involved, but I definitely want to welcome everyone to, if you have any questions, feel free to email me directly. Once again, will@perpetualpip.com or perpetualpip@gmail.com. If you have any questions, make sure to look for the notes in the description section. And if you like what you're learning, be sure to like and subscribe this video for more content coming in the future. This content's also available at perpetualpip.com. And when you decide that you've learned enough or you want some more thorough information, maybe put rubber to the road and trade with us live, join us in our live trading room. Take care. Thanks again for joining me.